I just dug up a presentation I did about a decade ago for the Canadian Society of Technical Analysts down in by Toronto area. And I pulled up this section here about cycles, and I wanted to just quickly show you an underlying view of how we go about looking at cycles, how I use them, which is probably much different than all of you are probably used to. So let's just jump down here. So here is an example of the SPY chart, and this is showing these cycles. This is 2016, and more or less, maybe I'll have to make this hair smaller. You can see I focus on multiple cycles that run through the market. So not just one cycle. You've got long-term all the way down to shorter active. If you were to blend all of these cycles together, these are time cycles, then you get this upper kind of blue line and the bias of it constantly wanting to push up and constantly wanting to come down. The longer term cycles will drive it up. The shorter term cycles will cause pullbacks or delays or pauses in price. And this is what the SPY was doing when I did this presentation. This was pretty wild. So I did this presentation and we were right here at a significant low, or coming up to one. We were a couple of days short. And I was saying, hey, we're looking for a nice wave to the upside in the SP 500. And the crazy part is if you see this move up and then fade to the side based on these cycles, this is projecting forward. If these cycles continue to carry on, this is the rough price action the SP 500 should have. And of course, if I was to pull up this chart, you can see this is the SP 500. Now we've got this move down, this move, and all these waves to the downside. And of course, we are right here with that cycle chart that I just showed you, and how we are looking for this market to want to move higher and run up. So if I was to just pull this over again, you can see in a nutshell, this low here and this low on the real chart shows how it ran up, had some blips, and then started to fade sideways. And so that's how we kind of gauge cycles in multiple cycles low. You can see there's two shorter term cycles bottoming in through here. It creates all these things. Now, if we just kind of continue to run through this a little bit with more detail, the way I view this is you run a spectrum analyzer, proprietary kind of, everybody, you can build your own or whatever, but what you do is you run analysis and it's checking to see how different cycles in the market, how frequently, which cycles stand out. And of course the spikes here are telling us, hey, there's these five cycles are the most frequent. They repeat over and over again. And you constantly run this to figure out what's the most active cycle, longer term cycles, shorter term cycles, and you use those. You don't want to use all these other random little cycles that are potentially there. You want the ones that repeat over and over in the most recent price action to figure out which cycles to use on the bottom of this chart. And that's what gives us this somewhat accurate-ish forecast. Now, one thing that's really important for people to understand is there's a thing called cycle skew, which longer term cycles will drive the underlying trend. Rising tide, falling tide, rising tide, falling tide. That's important to know. Shorter term cycles will create all the noise and the shorter waves and chop through the market. And cycle skew is really the most important to understand. And we actually saw this in 2022. I always talk about my presentation. Falling markets are very clean waves. Rising markets are skewed to the upper side, to the upside. But if we take a look at this chart, what we want to look at is this big blue cycle. Now, when the longer term cycle, the tide is going up, there's going to be a natural tendency for the market to want to rise. And with the shorter term cycles, you're going to want to definitely not want to buy into the market when there's a shorter term cycle high, even though it's down near a low and the trend's just starting. When there's a cycle topping out, you don't really want to get involved. You want to focus on when there's cycle lows. So if a major cycle is bottoming and you have other cycles bottoming at the same time, you can get these these sweet spots in the market where once it's stretched to the downside, people have washed and panicked out, then it naturally wants to go up to another cycle high. And they don't always time out perfectly by any means. These are fairly good examples, but you want to focus on these pullbacks. These pullbacks is usually when we're seeing panic in the market. We've got our own custom panic indicators to tell us when people are panicking And of course, we can apply it to our analysis and be like, hey, everybody's freaking out. We're actually feeling pretty good because this market should be putting in a bottom because the trends are bottoming or the cycles are bottoming. And then there's price dampening, which is really important as well, meaning if the longer term trend is down and you have an upward shorter term cycle, instead of a really strong rally and moving higher, it's going to really just kind of grind sideways or flat line. You're not going to get that bounce. You don't want to buy in a downtrend because the rallies are very short-lived. There's not much power to them. Instead, you want to focus on when the trend is down, focusing on a short-term cycle high, and when that trend reverses to the downside, then you want to catch where both cycles are telling you the trend is down. You want to go with the flow. Ride down the waves, ride up the waves, make sure the waves are in sync together when you do them. And that's kind of how that happens. So anyways, hopefully that gives you a little insight of the cycles. This isn't something I really teach. It's not something we really kind of give any of the details out. This is our own proprietary, some of the analysis we use behind the scenes and to get an idea of where these markets should be heading, kind of day by day type of thing. Anyways, that's it. Take care. Bye-bye.